At some point, almost every new investor sits down, ready to finally start putting money to work, and immediately runs into four terms that all sound like they mean roughly the same thing: index funds, mutual funds, hedge funds, ETFs. They all involve pooling money. They all involve some form of investing. And yet the differences between them could mean the difference between building serious long-term wealth and quietly handing a massive chunk of your returns to someone else every single year. Most people never learn what actually separates these four things. They pick one based on what they heard someone mention, hope it is the right choice, and move on. But the choice is not arbitrary, and understanding it clearly could be worth tens of thousands of dollars over the course of your investing life. My name is Tomas, and this channel is about finance, automation, and building wealth through strategies that are backed by evidence and built to last. If you are new here, welcome. Hit that like button right now and subscribe so you never miss a video. Today, we are breaking down index funds, mutual funds, hedge funds, and ETFs, clearly, completely, and without the jargon, so you know exactly what each one is, how they differ, and which one actually belongs in your portfolio. Let's get into it. Let us start by establishing what all four of these investment vehicles have in common, because that shared foundation makes the differences much easier to understand. What they all share, and why that matters. Index funds, mutual funds, hedge funds, and ETFs are all pooled investment vehicles. That means instead of buying individual stocks or bonds on your own, you are putting money into a fund that pools capital from many investors and uses it to buy a collection of assets. The fund owns the underlying investments. You own a share of the fund. This structure gives individual investors access to diversification, spreading money across many assets at once that would be impossible or prohibitively expensive to replicate by buying each asset individually. That is where the similarities end, because who manages the fund, how it is managed, what it invests in, who can access it, and what it costs are completely different across all four, and those differences have a profound impact on your returns over time. Index funds, the most powerful wealth-building tool most people underuse. An index fund is a type of fund built to track a specific market index. The most well-known example is the S&P 500, an index representing the 500 largest publicly traded companies in the United States. An index fund tracking the S&P 500 simply buys all 500 of those companies in the same proportions they exist in the index. When a company grows and rises in the index, its weight in the fund increases. When a company shrinks or is removed from the index, the fund adjusts accordingly. No human being is making active decisions about which companies to buy or sell. The fund just follows the index, automatically, mechanically, and at extremely low cost. And that low cost is the most important feature of all, because index funds do not require a team of analysts, a portfolio manager making active decisions, or extensive trading activity. Their expense ratios, the annual fee charged as a percentage of assets, are often as low as 0.03% to 0.2% per year. On a $100,000 portfolio, that is $30 to $200 a year in fees. Compare that to 1% or 2% annually, and the difference over 30 years of compounding is enormous. The historical case for index funds is also extraordinarily strong. Over the past 20, 30, and 40-year periods, the vast majority of actively managed funds where professional managers are making deliberate investment decisions, have failed to outperform their benchmark index after fees. The index wins not because it is clever, but because it is cheap, diversified, and consistent. For the overwhelming majority of individual investors, a portfolio built primarily around low-cost index funds is the single most evidence-backed approach to building long-term wealth. Mutual funds, the older, more familiar cousin with a critical hidden cost. Mutual funds have been around far longer than index funds or ETFs. They are the investment vehicle that dominated retirement accounts and personal portfolios for decades, and they are still widely held today, often inside employer-sponsored retirement accounts where people never closely examine the fees. Like an index fund, a mutual fund pools money from many investors and uses it to buy a collection of assets. The key difference is that most mutual funds are actively managed. A professional portfolio manager, or a team of them, makes deliberate decisions about which assets to buy, hold, and sell, with the goal of outperforming the market. This active management sounds appealing. The problem is that it costs significantly more than passive index investing, and the evidence that it consistently delivers superior returns after those costs is extremely thin. The average actively managed mutual fund carries an expense ratio somewhere between 0.5% and 1.5% annually, with some charging even more. There are also often additional fees, sales loads charged when you buy or sell shares, redemption fees, and 12b-1 fees that cover the fund's marketing expenses. All of these costs are paid by the investor, and all of them reduce the net return received. Here is what that means in practice. If a mutual fund earns 8% in a given year but charges 1.5% in annual fees, your net return is 6.5%. Over 30 years, that 1.5% annual drag compounding against you reduces your final balance by a staggering amount, in some cases cutting the ending value nearly in half compared to what a low-cost index fund tracking the same market would have produced. Mutual funds are not necessarily bad investments, but the fees must be examined carefully, and in most cases, a low-cost index fund tracking the same market will outperform an actively managed mutual fund over the long run after accounting for costs. ETFs, the modern, flexible, and highly tax-efficient investment structure. An ETF, exchange-traded fund, is in many ways the evolution of both the index fund and the mutual fund. Like an index fund, most ETFs track a specific index, the S&P 500, a bond index, an international equity index, a sector-specific index, or dozens of other benchmarks. And like a mutual fund, an ETF holds a collection of underlying assets that investors can access through a single purchase. The crucial structural difference is in how ETFs trade. While mutual funds and traditional index funds at many brokerages are priced once per day after the market closes and can only be bought or sold at that end-of-day price, ETFs trade on stock exchanges throughout the trading day, exactly like individual stocks. You can buy an ETF at 9:30 in the morning and sell it at 3 in the afternoon if you choose. The price fluctuates in real time based on supply and demand. For long-term investors who are not trading actively, this intraday trading flexibility may not matter much in practice. But ETFs offer two other advantages that do matter significantly. First, their expense ratios are typically extremely low, often comparable to or even lower than equivalent index funds. Second, ETFs tend to be highly tax-efficient due to their unique creation and redemption mechanism, which allows the fund to minimize taxable capital gain distributions. In a taxable brokerage account outside of retirement accounts, this tax efficiency can meaningfully improve after-tax returns over many years. ETFs have also exploded in variety. There are now ETFs tracking virtually every imaginable asset class: broad stock markets, specific sectors, international markets, real estate investment trusts, commodities, bonds of every duration and credit quality, and more. This breadth makes ETFs an extraordinarily flexible building block for almost any investment strategy, from the simplest 3-fund portfolio to more sophisticated allocations. Hedge funds, the exclusive, expensive, and frequently misunderstood category. Hedge funds are categorically different from the other three, not just in structure, but in who they are designed for and what they actually do. Hedge funds are private investment partnerships available exclusively to accredited investors. In the United States, that means individuals with a net worth over $1 million, excluding their primary residence, or an annual income above $200,000. The minimum investment is typically $1 million or more. Hedge funds are not for ordinary retail investors, and understanding why they exist clarifies a great deal about the investment world. Hedge funds use a wide range of strategies far beyond simply buying and holding assets. They short sell, betting that certain assets will fall in value. They use leverage, borrowing money to amplify the size of their positions. They trade derivatives, currencies, and complex financial instruments. They pursue market-neutral strategies that aim to profit regardless of whether markets go up or down. The word hedge in the name originally referred to the strategy of hedging risk by taking both long and short positions simultaneously. The fee structure of hedge funds is the starkest contrast with index funds and ETFs. The traditional hedge fund fee model is known as 2 and 20, a 2% annual management fee on all assets under management, plus 20% of any profits generated. On a $10 million investment that earns 15% in a year, the fund collects $200,000 in management fees plus $300,000 as a performance allocation. The investor keeps the rest. These fees are significant even when performance is strong, and devastating when performance is mediocre, which, as research has increasingly shown, is the case more often than the hedge fund industry would prefer to admit. Studies comparing hedge fund returns to simple index fund portfolios over 10 and 20-year periods have repeatedly found that the average hedge fund, after fees, underperforms a basic stock and bond index allocation. For wealthy institutional investors managing complex portfolios with specific risk management needs, hedge funds may serve a genuine purpose. For the individual investor building personal wealth, they are largely irrelevant, and the fee structure alone makes them a poor substitute for the low-cost, diversified, long-term approach that index funds and ETFs provide. The bottom line, which one actually belongs in your portfolio? If you are an individual investor building wealth for the long term, the answer is almost certainly a combination of low-cost index funds and ETFs. They offer broad diversification, minimal fees, strong historical performance relative to actively managed alternatives, and the tax efficiency that keeps more of your returns compounding in your account rather than flowing out in costs. Mutual funds can be appropriate, particularly if your employer retirement account offers well-chosen, low-cost options and there is no direct ETF alternative available. In that case, focus obsessively on expense ratios and avoid any fund with a sales load or excessive annual fees. Hedge funds are not relevant to most investors reading this and are best understood as context. They exist, they serve specific purposes for specific wealthy clients, and they are not the mysterious wealth-building engines that popular culture sometimes suggests. The vehicle matters. The costs matter. And the clarity to understand the difference between these four options is worth building before a single dollar is invested. So let us bring it all together. Index funds track a specific market index passively, charge minimal fees, and have an extraordinarily strong long-term track record against actively managed alternatives. Mutual funds pool investor money under active professional management, tend to carry higher fees, and most fail to consistently outperform their benchmark index after costs are accounted for. ETFs combine the passive, low-cost structure of index funds with the trading flexibility of individual stocks and exceptional tax efficiency, making them one of the most powerful and versatile tools available to individual investors today. And hedge funds are exclusive, expensive, high-strategy investment vehicles designed for institutional and ultra-high net worth investors, not the wealth-building tool for the individual building a personal portfolio. Know what you are buying, know what it costs, and build your portfolio around the vehicles that have consistently proven themselves over time. If this video gave you clarity on something that has been confusing for a while, please hit that like button. It genuinely helps this channel grow. And if you are not subscribed yet, click that button right now so you never miss what is coming next. See you in the next one.